Hello friends, happy Mother's Day to all the mothers watching the video. In today's video, I will cover some of the important numbers released during the week which has an impact on Indian economy. Also we'll cover a glooming worry which might have a serious impact on the world's largest economy. As usual, we will cover how financial markets performed last week. On the occasion of Mother's Day, we'll have a short personal finance lesson which single mothers should know to achieve their financial goals and for their family's well-being. My name is Raghu Kumar, a certified financial planner by qualification and founder of FinSim. Let's start with our domestic economic news. In a major relief, consumer price index inflation for the month of April 2023 fell to a 18-month low of 4.7%, which shows that the monetary policy of RBI is in the right direction. After the last Monetary Policy Committee meeting, RBI halted the interest rate hike and kept the rates unchanged. April month inflation rate proves that the monetary policy is working efficiently in mitigating inflation. If the trend of inflation shows further slide over the next few months, we can expect RBI to cut rates during the last quarter of this financial year. This will be a great relief for quite a lot of individuals as the heat of higher interest rate is already being felt by many in the form of higher interest outflow resulting in higher EMIs or extension of loan tenure. While the inflation turned out to be a good news, the index of industrial production growth disappointed with a growth of 1.1% in the month of March 2023. This is the lowest over the past 5 months. For the financial year 2023, it has risen by 5.1% as against a growth of 11.4% witnessed during FY 2022. India's foreign exchange reserves rose sharply by USD 5.977 billion to USD 578.778 billion, hitting an 8-month high. Since second half of last year, RBI has been intervening regularly in the currency market by way of selling US dollars to defend a steep depreciation in the rupee. With rupee stabilizing around 82 rupees per dollar, RBI has been constantly accumulating US dollars for over the past few weeks. Current reserves of US dollars is now sufficient to cover 10.4 months of our imports. Let's now look at an alarming news from world's largest economy, that's US. The US may default as soon as 1st of June, which will cause a global economic catastrophe. This would happen in case the Congress doesn't approve the increase in the debt ceiling limit. Debt ceiling limit is a law that limits the total amount of money which the government can borrow to pay its bills. On a periodical basis, US Congress votes to raise or suspend the ceiling so it can borrow more. The cap currently stands at roughly $31.4 trillion. This limit was breached in January, but the Treasury Department used extraordinary measures to provide the government with more cash while it figured out what to do. Treasury Secretary Janet Yellen has warned that without more borrowing, the US will not have enough money to meet all of its financial obligations as soon as 1st of June. The last time it happened, the US saw its credit rating downgraded and interest rates on its existing debt go up. Even if the nation avoids stumbling over the fiscal cliff, the US economy could suffer. Time for a quick view on how the financial markets performed over the last 1 week. Nifty 50 managed to move up by 1.36%, whereas the wider indices, that is mid cap and small cap indices, continued their run to give a gain of 1.08% and 1.15% last week. Major move was witnessed in the auto sector thanks to Tata Motors and Maruti Suzuki, which are the heavyweights in the auto sectors, and both have surged by 4% and 8% respectively last week. Gold moved up by 1.19%, whereas Brent crude dropped by 1.5%. INR to USD gained a small 0.14% to end the week at 82.26 rupees per dollar. Most of the US and Europe indices were trading flat, but the MSCI Emerging Market Index surged by 2.13%. Another major aspect which we should look at is the foreign institutional investors' flow of money into Indian market. For the third consecutive month, we are seeing a positive inflows into Indian markets, which is a positive sign. Time for a quick lesson on personal finance. Money Control published an excellent article on how to manage finances for single mothers. This is a must read for all. I will try my level best to give a short summary of it here. You can find the link for the article from the description box. Starting point of any exercise is to plan for it. A comprehensive financial plan is a must for all, especially single mothers, as it will assist them in achieving the financial goals like retirement, kids' education, or even handling emergencies in an efficient manner. We need to lay down a strong foundation by availing sufficient insurance coverage by way of term insurance or medical insurance, and also build and maintain emergency fund. We need to estimate the corpus required for retirement and goals like kids education or purchasing a house. In case of resource crunch, to achieve all the goals, priority should be given to retirement over others. Because for other goals you can always avail loans, but for retirement you cannot. Following a systematic investment approach based on your goals is always recommended. Earlier you start, better it is, as principle of compounding works well when you give it time. Asset allocation is once again a must based on your risk profile and goals. Monitor your financial plan and adjust it on a regular basis. Last but not the least, prepare a will to determine the recipients of one's property and appointing an executor to safeguard child's interest. Hope you like this new series. If you like the video, please do not forget to subscribe to our channel, like the video, and also click on the bell icon to receive notifications as and when new videos are uploaded. You can always reach out to us on the mobile number and the email ID listed on the screen for a 15 minutes consultation without any obligation, and we would be more than happy to assist you with your queries. Thank you.